In this video, we will touch on 4 retail REITs that are popular among Singaporean investors. Make sure to stay till the end because we will do a quick comparison in a table for these 4 REITs as well. With that, let's dive in. For a quick background, did you know that there are more than 10 retail REITs listed in Singapore? The table below shows the 8 retail REITs in order of ascending market cap, from the smallest to the largest. Such is the love of shopping we have in Singapore. And given that there are so many retail REITs, we are just going to focus on 4 of them, namely CapitaLand Integrated Commercial Trust or CICT, Mapletree Pan Asian Commercial Trust, MPAC, Fraser Centrepoint Trust, FCT, and Lendlease Global Commercial REIT, which is LREIT in short. So with that, let's hop on to the first one, CICT. CICT is the first and the largest REIT listed on SGX with a market cap of around $13.5 billion. While many of us know CICT for their shopping malls like Junction 8, Lot 1, Bugis Junction, retail only contributes 30% of their entire property value, while office and integrated developments commands the other 70%. In the latest business update ended 31st of March, CICT reported net property income increased by 11.3% to around 276 million, mainly from the acquisitions completed in first half 2022. Overall occupancy rate, is also up slightly to 96%. They have garnered positive rent reversion for both the retail and the office portfolios. CICT gearing ratio currently stands at 41%, and interest cover has gone down from 3.7 times to 3.4 times in March 2023. So the second on our list is Mapletree Pan Asia Commercial Trust, MPAC. As the name suggests, their portfolio comprises of 18 commercial properties across Asia. So we have Singapore, Hong Kong, China, Japan, and even South Korea. Some notable names are like VivoCity, and Festival Walk in Hong Kong, and also Mapletree Business City. In the results ended 31st of March, they reported net property income is up 62.6% to around 631 million, boosted by the contribution from properties acquired through the merger and better performance of their core assets. However, gearing has a huge jump from 33.5% to 40.9%. And the full year DPU was up only slightly, around 0.8% year on year. Interest cover has also deteriorated from 4.8 times to 3.5 times. In a nutshell, diversifying into foreign properties in Asia is pulling down the results of MPAC, given the strong Singapore dollar appreciation against the foreign currencies. Before we continue with the next retail REIT, if you are keen in dividend stocks and REITs, do remember to subscribe to the channel and also turn on the notification bell to be informed whenever we cover such videos. In return, here's a financial meme for you. Okay, so let's move on to the third REIT. We have Fraser Centrepoint Trust, FCT. It is the largest suburban retail mall owner in Singapore. While CICT owns malls in more downtown areas, FCT owns the neighborhood kind of malls like White Sands, Causeway Point, Nex, and more. What's impressive is that it boasts an incredible high 99.2% occupancy rate compared to around 96 to 98% for CICT. As for the half-year results, ended 31st of March, it reported net property income is up 5.7%, while DPU is dipped slightly to around 6.1 cents. Gearing ratio is still below 40% at around 39.6% compared to the other retail REITs, which is above 40%. On the bright side, right, tenant sales is 9.2% higher year on year, and shopper traffic is up 35% year on year. This bodes well for FCT in their negotiations with the tenants, right? Especially when the other areas are more expensive. In fact, rental reversion rates are up an average 4.3%, and the top tenant is blue chip tenant NTUC FairPrice. So the last one on our list is Lendlease Global Commercial REIT, also known as L-REIT. L-REIT's portfolio is more straightforward. You have 313 Somerset, GEM, and the recent acquisition of a stake in Parkway Parade, plus another 3 freehold office properties located in Milan, Italy. So in the business update as of 31st of March, L-REIT reported overall portfolio occupancy of 99.8%, even higher than FCT. The average, weighted average lease to expiry, WALE, is also very long at 8.3 years, mainly due to the long WALE of the office portfolio in Milan, right? That is around 12.2 years. So on top of that, right, the current interest cover is at 4.6 times, and they have a gearing ratio of around 39.3%. However, investors should take note that the gearing ratio increased to 40.4% with the acquisition of a 10% interest in Parkway Parade moving forward. In conclusion, let's now compare the 4 retail REITs together in a table based on few financial metrics. From the table here, you can see that other than the gearing ratio, where the FCT just stands out slightly, L-REIT actually stands out among the other retail REITs in terms of when you talk about occupancy rate of 99.8%, the long WALE, and above 7% distribution yield right now. On top of that, right, when we want to compare the valuation, you compare L-REIT to the peers, it shows that trading at a cheaper price to book ratio of around 0.7 times, probably due to the smaller size in market cap. With that, do you think that Lendlease REIT is the best retail REIT in Singapore right now? Let us know whether you agree with the statement or not in the comments down below. With that, if you find this video helpful for you, remember to tap the like button and subscribe to the YouTube channel for more such stocks analysis. Thanks for watching, and I will see you next time. Bye.